and welcome to Indianomics. On Tuesday, the Reserve Bank will set the new price of money for the economy. What are the expectations from the monetary policy? I have four financial stalwarts to discuss that. I have Dr. Pronob Sen, the economist, currently chairman of the Statistics Commission and formerly chief statistician of India. I have Sajjid Chinoy, the chief economist from JP Morgan, Neeraj Gambhir, the co-head of fixed income at Nomura, and Mr. Pradeep Kumar of State Bank of India, who will be joining me in just a bit. But before I get to my experts, let's lay out for you the CNBC TV 18 poll.
Governor Rajan will stay put on rates on August 4th. Say a 90% of respondents polled by CNBC TV 18.
Now we are, as before, contingent on the data.
The man has always maintained that RBI's rate cut decision is data dependent. And with falling inflation, the RBI indeed cut repo rate by 75 basis points to 7.25% from January through June in 2015. But this time, given the uncertainty over monsoons and the hiccup in food prices in July, he will stay steady not just on repo, but cash reserve ratio or CRR or statutory liquidity ratio or SLR as well. Barely 20% of respondents expect him to cut SLR by 50 basis points this time. SLR being the reserve requirement banks must keep with RBI in form of gold, cash or securities. More importantly, all eyes and ears are keenly awaiting Governor's take on GDP and CPI forecasts. Amid evolving growth inflation dynamics and with the wholesale price index WPI faced inflation that remained negative for the last 8 months, a few but respondents do expect to see change in that stance. 40% of respondents polled by CNBC TV 18 expect the RBI to lower its GDP forecast to below 7.8%, while 60% said he won't touch the current forecasts. On inflation, 20% expect CPI to lower from current 6% levels to between 5.5 to 5.9%. But a majority expect no change. As for the governor's tone, 60% of respondents expect it to remain neutral.
But hope springs eternal. 80% of the respondents we spoke to, they say another rate cut is due from Governor Rajan. And most likely that will come in post-monsoons once he's sure about food inflation. They say a 7% of repo rate cut is expected by the end of this calendar year. In Mumbai, Manasvi Gilani.
Well, those are the quantitative expectations or the quantitative forecasts. Now for a qualitative forecast of the monetary policy, let me get to my experts, Dr. Pronob Sen, Sajjid Chinoy, Neeraj Gambhir and Mr. Pradeep Kumar. Gentlemen, thank you very much for joining me. Well, Sajjid, let me start with you since I want an economist come market perspective. In the previous policy, the governor had raised the inflation forecast for January 2016 on the ground that crude prices had risen, as well that the monsoon is likely to be dicey this time. Now, at the end of 2 months, we know that crude prices are back to their near-term lows. In fact, they are at near 5-year lows. As well, the monsoon is not as bad as the Met had forecast. It's probably only 3% deficient as of now. Do you think in the first place there is a case to bring down the inflation forecast itself?
Latha, you're exactly right. I think compared to the last policy, inflation risks have clearly receded, both for domestic and external factors. You spoke about the monsoon being better than expected. We've done some empirical work to suggest that unless the deficiency is 15% and more, there is no historical impact of a deficient monsoon on food inflation. So we're very far away from that threshold. Globally, I think not only have oil prices abated, but global food prices have also come down. And I think we'll be surprised by the linkage that exists between global food prices and India's food inflation. So I think you're right. Whether they formally move that forecast down or not could well be tactical. But you're right. I think the RBI stays on hold for now. But with inflation risk coming down domestically and externally, the likelihood or the risk of some easing down the line has certainly gone up.
Okay. Well, Dr. Sen, the same question to you since you monitor the inflation numbers very closely and the factors that affect it. Is there a case in the first place for even bringing down the inflation forecast?
I think there is. In fact, I was a little surprised when the governor actually said that he was upping the inflation forecast for next year because, you know, the underlying sort of conditions of the food economy, the agri-economy in particular, are such that even if the rainfall is deficient, inflation is unlikely to go very high, except possibly in certain kinds of crops. Which leaves the issue of oil prices. And, you know, as far as oil prices is concerned, frankly, I don't see much logic in trying to second guess that. You know, there's been so much volatility, it's so susceptible to
Dr. Sen,
external conditions.
But Dr. Sen, it is still necessary to estimate it and to give it a figure.
Well, no, it's necessary to take a call on it, but it's also equally necessary to ask yourself the question that can you or should you do anything about it? Okay. Or should you, for the moment, assume business as usual and then ask the question, what are the rest of the prices doing?
So your take would be that since you began by saying you were surprised that the governor even raised the forecast in the previous round, you think there is scope to cut rates right now?
Well, yes, I do. Frankly, I think there's fairly substantial scope to cut rates. At the moment, as Sajjid rightly pointed out, global food prices are weak. The monsoon is fairly decent. There is going to be some crops which are going to be affected. Onions have already shown some strain. But by and large, I see no real risk of inflation over the next 5-6 months. And I think a rate cut would be on the card. It can be reversed later if things turn bad.
Okay. Well, just to complete this argument, Sajjid, we nevertheless saw food prices and inflation in general come above market expectations for the latest month, for June. So, does that deter the Reserve Bank from going ahead with a cut?
So, you know, I think the glass is half empty and half full. I agree that in the last 3-4 weeks in particular, inflation risks have receded for the reasons we mentioned. But if you just look at the last June CPI print and strip away all the noise, what you essentially see is underlying inflation, core inflation measured in different ways, has stabilized somewhere between 5.5 and 5.7. And in fact, the momentum over the last 3 months has actually increased. This will be a source of concern to the RBI because what it suggests is even though any cyclical recovery is modest, along with that recovery, we're seeing pricing power picking up. Now, of course, you know, this could all change. If you tell me input costs are going to go down substantially because oil prices are down, then, you know, maybe pricing power doesn't have to rise in tandem with growth. But the fact that core inflation has picked up the last 3 months, underlying inflation is at 5.5, and let's not forget the big elephant in the room, the Fed. You know, we're substantially more insulated from global shocks. Our current account has collapsed. But the RBI would still want to see how disorderly or orderly any Fed exit is going to be in September, which is why I think they will stay on hold next week, perhaps flag that risks have come down, but only pull the trigger in September once they are sure that the monsoon was normal and any Fed liftoff has not been disorderly.
Neeraj, would you buy that?
I think I'll agree with Sajjid's views. Broadly, while the inflation risks seem to have receded a little bit, there are still the major event of Fed which needs to be watched for. There is obviously monsoons, which is we've seen half the period of monsoons get over. There is so far no cause of concern, but the rest of the half is equally important. So my guess is that Reserve Bank would like to wait to see how the full period of monsoon plays out. There is some report of sporadic increase in prices, for example in onions, where there is a probably it's a one-off event, but there is some increase in prices. So there are those tendencies of volatility in food prices which need to be sort of watched carefully. And I would think that in general, Reserve Bank will be in a position to take a much better view of the situation somewhere closer to September and October, when there is clarity about Fed rate increase, there is clarity about monsoon situation, and you have seen sustainability in the oil prices at the lower levels for some time, for them to be able to take a much more measured call. Though our house view currently is that the Reserve Bank stays on hold for rest of this year.
Okay. Well, Mr. Pradeep Kumar, now a question that is material to citizens. Do you think a Reserve Bank rate cut is all that necessary at this juncture for banks to move their hand? And the second part of the question, there is not much credit offtake. Is there any way scope for banks to make money cheaper for both for depositors and for lenders, for borrowers?
See, if you see our bank's policy, we have been consistently reducing the deposit rates, and we have also decreased our base rates. If we have to decrease our deposit rate further, we are afraid the deposit growth will be hit very badly, because the competing instruments like the small savings of the government are paying much higher. So if the government is very serious of bringing down interest rates, the government has to seriously look at bringing down the small savings rate. Without decreasing small saving rates, it will be difficult for banks to cut further deposit rates as of now.
So, irrespective of what the RBI does, then your position becomes the same, that it's not going to be, let us assume there is a rate cut, even then it will be difficult for you to drop rates, according to your argument.
Yes, because if you see over the last time when RBI was raising rates, when they raised rates by 75 basis points over a 6 or 9 month period, the bank's base rates increased, our SBI's base rate increased by 30 basis points. And the same thing has happened now when the base rates, when the repo rates have come down by 75 basis points, we have brought down the base rate by about 30 basis points. We can relook at this if we are able to bring down our cost of funds. Our cost of funds in India is primarily cost of deposits. We have been trying to push it down. I think in SBI especially, our cost of deposit for the 1 year bracket, which gives the maximum deposits for the banking system in the country, is the lowest. As I told you, we are constrained by the small savings rate. If the small saving rate comes down, we will be in a position to have a relook at the deposit rate. And if we are able to bring down our cost of deposits, we will be able to certainly be able to bring down the deposit rates also, the base rates also.
Let me persist for just once more on this issue. Mr. Pradeep Kumar, small savings have their problems as well. They are not as liquid as a fixed deposit. As well, in the past we have seen bank deposit rates fall below small savings rates on several occasions. Since your credit offtake is so low, what is your assessment of the way in which deposit and lending rates will proceed in the rest of the year? Do you think there is going to be any further cuts at all to deposit and to base rates in 2015?
I believe that if the monsoon is good and the inflation expectations are reigned, we can expect a cut from the RBI, and if not immediately, at least in the October policy, the banks will have to relook at that point of time. The credit offtake is not very good, there is no expectation of a credit offtake, we'll have to look at our funding cost and reduce our funding cost.
But as
banks, I think, will have a relook maybe sometime in October.
Okay, so as of now, if the RBI does not move, you're not seeing any move till October?
No, at least in SBI, I don't think we see a move till October, because recently, I think early part of this month, also we have cut down deposit rates.
All right. So that's one person expecting a cut, but the other three experts not expecting a cut and not expecting that it's going to get passed on either. Let's take a break on that note. We are back with a couple of more questions that could be addressed by the monetary policy. Back in a minute.